Good afternoon, everyone. Thank you very much for taking the time to attend my presentation. As we just heard, I am the fund manager of F&C Investment Trust, the oldest investment trust in the world and one of the largest in the UK. What I intend to do for the next 20 minutes or so is run through the background of the trust, the way that we invest, give you a sense about the results that we've delivered, and I'll talk about some of the key issues that are front and centre of mind in terms of our consideration when we are thinking about where to allocate capital in today's difficult markets. So here you can see that we've been serving retail shareholders for over 150 years. The trust was established in 1868, originally setting out with an objective to provide small shareholders access to the same opportunities as large capitalists of the day. So essentially, all the way back in 1868, launched as a retail product. We have paid a dividend every single year since 1868 and are the longest continually listed company in the UK. In addition to that long track record of paying dividends, we've paid increased dividends year on year, every single year for 54 years. There's been continuity in terms of management of the trust. There have only been 11 managers since launch back in 1868, 3 since 1969, and I took responsibility for the trust in the middle part of 2014, so just over a decade ago. Now, we started out investing in government bond markets outside of the UK, but we started investing into equities in the 1920s and largely in equity exposure by the 1960s. So in recent decades, we've focused very much on listed equity and private equity, what we would categorize as growth assets. We've got significant scale, as you've heard. So our market capitalization is around £5.5 billion. We have total assets in excess of £6 billion, and we are a member of the F&C 100. We're in the mid-60s in terms of our position within that particular index. What do we seek to deliver? The overriding objective is to deliver long-term growth for shareholders in capital and income. The way that we seek to deliver that objective is by investing into listed and unlisted growth assets. So as I said, equities and private equity. And we do that in a manner where we blend together a range of focus strategies. So the previous speaker was talking about a concentrated portfolio of stocks, 40 stocks in that particular trust. What we do is we run a whole range of different mandates, each of which has a specific objective, is focused, and by blending together those individual strategies, we aim to add returns while reducing risk. And I'll talk a little bit more about that as we go through. We do have a commitment to a net zero portfolio by 2050 or earlier, and that is part of the commitment that the board have in terms of using your capital as shareholders effectively from a stewardship standpoint. The outcome that we have seen and that we intend to deliver going forward is one of consistency. Consistency in terms of performance delivery as well as value for money for shareholders. So here I show you the dark line, global equities, the light blue line, UK equities. The trust made a very conscious decision, strategic decision, more than a decade ago to pivot from what I would regard as an overexposure to UK equities to a more global approach. That's been a really profitable decision for shareholders. This shows you that UK equities, while a global laggard, have performed very strongly, roughly doubling money over the period of this chart here, which is from the beginning of 2013 when we made that change. Global equities, by contrast, obviously undertaking or undergoing a period of volatility right now, but as at the end of last year, had delivered something like a 4 times return on money over that same period. So we're global, looking for the best opportunities from across the global marketplace. We intend to be a one-stop shop for investors looking for exposure to listed equity and private equity. So as private or retail shareholders, you may not want the challenge of selecting different strategies, different geographies, different styles, different industries for investment. I and my team undertake that role. We intend to provide a single solution which is diversified across different components of return, geographically, sectorally, and stylistically. So on the left-hand side of this chart, what you can see is the exposure in US strategies. So 45% in the US, as you can see. And within the inner circle there, that shows you that we've got different types of strategies within the US. So again, reflecting on what you heard earlier on, there's different ways to invest, not only within the US, but in global markets. But broadly, aside from large cap, small cap, mid cap, one can think about growth investing, value investing, quality investing. There are three of the main labels which will be attributed to funds or managers in terms of the way that they invest. Now, the reality is that there is more than one way to win in terms of investment in equity markets. In the long run, investing in value stocks, on average, tends to outperform the global index. In the long run, investing in high quality companies tends to outperform the index. And investing in high momentum or growth stocks tends to outperform the index. Challenge is that that performance and outperformance is not consistent. So by having different components of the portfolio, geographically, stylistically, and by sector, we can blend these areas together and manage them through the cycle. Different economic environments are more or less conducive to performance in different areas of the market, and that's something that we look to manage actively. On the right-hand side of the chart here, you can see the top 10 listed holdings at the end of the year, and there's many familiar names, several of the Magnificent 7 stocks make an appearance in our top 10 holdings, but we are actually light against the market and have been light against the market in terms of having less exposure than a market capitalization weighted index. We've got low cost fixed rate debt. Now, one of the tremendous advantages that we have as an investment trust is that we can borrow to invest. And in the last decade, we have fundamentally restructured our debt. We've undertaken around £580 million worth of borrowings. And what you can see here is that £580 million of borrowings and how much is due in the next 10 years, the next 10 to 20, 20 to 30, and so on. And what we're paying in terms of fixed interest rate on that debt. So the average interest rate, fixed term interest rate that we pay on that debt is 2.4%. And we borrowed out to 2061, that was a 40-year borrow, at 1.87%. So the way to think about that is that we can take that capital that we have borrowed, invest it into equities or private equity, and make a return above the cost of borrowing, then that will add returns to our net asset value and provide returns for you as a shareholder. So very, very attractive and low fixed rate debt, low cost fixed rate debt. As I said earlier, we've got a commitment to raise dividends. Here you can see our track record in recent years of growing revenue. As a company, we generate revenue from the investments which we make. That revenue helps us to pay dividends. As I said, we paid a dividend every single year for more than 150 years, and subject to shareholder approval, we'll deliver a 54th consecutive rise in dividends this year. So a tremendous track record. We are an AIC dividend hero. Our dividends are covered, and we've got significant revenue reserves, which means we can have confidence that despite market ups and downs, we're in a very, very good position to not only continue to pay dividends in future years to shareholders, but to pay rising dividends to shareholders. And in terms of outcome, we've delivered strong returns. This shows you the annualized return over 1, 3, 5, 10, and 20 years, bar chart showing the net asset value and shareholder return on the left-hand side of the screen here. So last year, for example, 21% return for net asset value, 16.9% in terms of shareholder return. If you look at longer term, we've consistently delivered returns. It's been a fantastic period for equity markets, clearly, but consistently delivered returns over 10 and 20 years, which have exceeded 10% per annum for shareholders. So this point about consistency is really, really important. We're diversified, as I said. We invest across a range of different areas. And the reason for that is to provide a smoother performance outcome for shareholders. And we do well against competing trusts. The right-hand table here shows you the quartile ranking against our peers in the investment trust sector, the global growth sector. And you can see that, again, over 1, 3, 5, 10, and 20 years, we've delivered returns ahead of our peers, first or second quartile over all those periods, and ahead of benchmark over all those periods as well. So this point of consistency as one of the objectives that we have is really, really important. And this, I think, is a strong proof statement underpinning the delivery that we have achieved for shareholders. And just looking at this slightly differently, again, looking at the returns of the trust FCIT, the dark blue line here against global equities, global equity index and the UK equity index. It's been a great 20-year period for UK equities. You can see an even better period for global equities, but our outperformance for shareholders means that we have delivered an even better return, around a 750% return for shareholders over the last 20 years, which is more than 12% per annum compounded over that period. And we do that with a focus on value for money. So I work for Columbia Threadneedle Investments, the manager of the trust. We charge on the market capitalization of the company. So when the market capitalization goes up as a function of either growth in net asset value or a narrowing of the discount or moving to a premium, that's good for our fee income. And conversely, when the net asset value or the discount widens, then we will earn less. So our interests are fully aligned with those of the shareholders because we get paid essentially on the market capitalization of the company. And this shows you the progress that we've made in recent years in terms of value for money, ongoing charges. So the ongoing charges for the trust are 0.45%. One thing that I didn't mention earlier on, and that is also worth pointing out, is that we invest and make selection of managers from across the market. So in the case of US equities, we have a growth manager, JP Morgan actually, we use in a growth mandate for us. They run £1 billion for us in a separate account in US large cap growth stocks. We also use a third-party value manager called Barrow Hanley, based in Dallas, just like value stocks for us. And we blend those managers as well as internal Columbia Threadneedle capabilities as part of an investment proposition. In the private equity space, similarly, we have just over 10% of the portfolio invested in private equity, unlisted private market opportunities, including co-investments, which are individual company investments, and fund investments. And the charges of all of that exposure in terms of the Columbia Threadneedle managers, the external managers, and the private equity are captured within that OCF of 0.45% there. And this shows you a snapshot of our look-through exposure. So we've got a range of different strategies, each of which are focused, each of which diversify to each other. And this shows you how much, as at the end of the year, we had in North America. So just under 64% of our assets in the North American area, around 9% in Europe, 9% in the UK, and so on. And technology is the single largest exposure that we have from a sectoral perspective. Now, if I come back and talk next year, or indeed you look at our presentation from last year, you'll see different composition in terms of exposure. So we manage that exposure through time, geographically and sectorally, as well as stylistically, to take account of the overall macro environment and the outlook that we see for the respective opportunity set in the listed and unlisted space. So I'm going to, in the last few minutes, just make a few comments as to market perspective. I think, needless to say, the outlook is inherently uncertain. It always is, but it feels like the current backdrop is even more challenging than usual. There are a few things which are clearly front and center of mind when one takes a step up from the individual stock discussions and thinks about the macro backdrop, the geopolitical backdrop, and all that is going on. You may have noticed we have a new US president, still relatively new US president, radical plans in terms of tariffs, immigration, deregulation, taxation, and we've seen considerable movement, not always consistent thus far, with respect to the narrative on tariffs. And indeed, next week, 2nd of April, has been coined Liberation Day by the president, so we're expecting some big announcements to be forthcoming in terms of reciprocal tariffs. And that could have really big implications for the global landscape, the global growth outlook, the global inflation outlook, and importantly, risk appetite from investors. Investors hate uncertainty, and what we're seeing is a tremendous amount of uncertainty. We've also seen, partly forced, I think, by events in the US, what is a really game-changing move in Germany and in the EU, in the Eurozone overall. Germany are moving forward in terms of changing the constitution, taking the debt brake off, massive plans in terms of infrastructure and defense spending, which are going to have a very significant positive impact in terms of future growth in Germany, as well as across Europe. Now, the stock market has responded to some of that already. There's been tremendous performance in defense stocks, European defense stocks, Rheinmetall, and others performing fantastically strongly. But this will be a slow burn, longer term, positive impetus to European growth, albeit, to be fair, concentrated in a relatively, up to this point, narrow segment of the economy. The market has also taken notice of the large proposed rise in fiscal expenditure, and market interest rates in Germany have pushed higher, as has the euro. And that's something of a headwind to growth. So that offsets, to some extent, some of the positive element from looser fiscal policy. Big market question clearly relates to US exceptionalism. The US has been the exceptional region or area in global equities for the last 10, 20 years, driven, as I'm sure you're aware, by a narrow cohort of really exceptional companies. Is that exceptionalism over? Is that premium rating that the US commands over? We don't think it is, actually, but certainly we're looking for more balanced performance, which we've seen year to date thus far. So a broadening in the market is expected. So what does all that mean for markets? Well, I can raise some of the points. I don't have all of the answers, but this gives you a sense of, I think, one of the big stories from 2024, and actually thinking about 2025. Growth and inflation, the domain of the economists, are really important in terms of shorter term market moves and indeed longer term outcomes. On the left hand side here, you can see what economists were expecting through time for the outcome for US, European, UK, and emerging market growth last year. And the big story really was the blue line going up. Just over 12 months ago, the concerns were very much about risks of US recession. There's real concern about the outlook for US economic growth. There was very aggressive rate cuts priced in by the US Federal Reserve, that's the central bank in the US. But subsequently, the US economy actually performed a lot more strongly than most people had assumed. And that blue line got consistently revised up, such that once again, the US proved its exceptionalism in terms of the economic outcome. 2025 5, you can see on the right-hand side of the bar chart on the right-hand side of the slide, shows you that US growth perspective is expected to moderate in this year. So still a premium growth outcome from an overall economic perspective in the US, better than the US, better than the Eurozone, better than the UK, but lower than we saw last year. Conversely, actually, a bit of an upturn expected in the EU and the UK. So a premium growth outturn, but the gap between the US and the rest of the world is expected to narrow. Interest rates, again, the domain of the economist, but really important in terms of market pricing, in terms of equities. One thinks about equities as a stream of future cash flows or dividends, and interest rates give one of the inputs that you can think about in terms of discounting the present value of all those cash flows. So all else being equal, finance theory tells you when interest rates go up, the multiples come down. People pay less for the future cash flows. What the chart on the left-hand side shows you is what the market is expecting in terms of interest rate cuts from the US Federal Reserve. Again, that is the US Central Bank. So through to the end of 2025, the market is expecting 2 or 3 interest rate cuts and more to come in 2026. And you can see some of the recent response, well, in the last few years, from government bond markets as interest rates normalized, i.e. were pulled up from close to the zero bound to higher levels, to a more normal level from a historical standpoint, and have subsequently been diminishing or coming down. Our expectation is that we are going to see further cuts from the US Federal Reserve this year. The market doesn't seem too far out in terms of our expectations. And broadly, this combination of a reasonable growth outlook and interest rate cuts tends historically to be a good period for equity markets. When growth is positive, when rates are cut, when inflation is relatively low, that tends to be a relatively good period for equity markets. Now, one of the points I made earlier on was around tariffs, and that is one of the big risks that clearly we're thinking about as investors, and obviously the market is concerned about. What we've seen thus far is President Trump signaling that he intends to take average tariffs in the US up to around about 12%. Putting that in context, his first presidency took the average level of tariffs from about 1.5 to 3. So we're currently around the 3% average tariff level. His plan is to take it up to around 12. It remains to be seen how far he moves on that journey, but that clearly will be negative for growth and it will push inflation rates up. So this benign backdrop, relatively benign backdrop, which I've outlined, of good growth, interest rate cuts is at risk, clearly, from tariffs. Tariffs will reduce growth, raise inflation, and potentially dissuade central banks from the rate cuts which are currently priced in. Earnings, really important for equity markets, clearly. Left hand shows you how analyst expectations change on a calendar year basis. So they start off, for example, 2025, anticipating that global earnings growth is going to be something like 13 or 14%, I think, and they started to revise that down. Those downgrades are becoming more aggressive. Analysts are becoming more concerned about the impact of uncertainty as well as the direct impact of policy on the economy and the earnings outlook. And I think this is really, really difficult to model. But there will be an impact in terms of business expenditure, capital expenditure, and consumer confidence that we're beginning to see already that may well drag down the earnings expectations you can see on the right-hand side here, where again, the US is expected to deliver a premium growth outcome, but that 12%, which is currently expected, is probably going to be revised down. Our expectation right now would be the mid to high single digits. So some downgrades to come, better than Europe, better than Japan, better than the UK, but not as good as currently assumed. And that's going to be a bit of a headwind, I think, to markets. So this point on US exceptionalism, the US has led the way in return terms in recent years. This chart shows you since beginning of 2020, just before COVID hit. And you can see the top line there is US equities, far and away ahead of the rest of the world. The rest of the world represented by Europe, UK, Japan, and emerging markets down the bottom. And China, that green line, seeing something of a recovery after many people regarded it as uninvestable. That was actually the time when China began to perform, when people had really thrown in the towel, when investors had capitulated, when valuations had really reached an abnormally low level. Performance began to pick up as bargain hunters moved in. But the US performance has really been world beating, and it's been narrow. So this shows you the Magnificent Seven, that group of 7 leading companies, Nvidia, Microsoft, Amazon, and the rest, how they have performed since the beginning of 2017, up despite the recent setback where they've fallen by about 20% in aggregate, or give or take. They're up about tenfold over that period. And the Magnificent Seven, that group of 7 companies, are bigger in aggregate than any individual global equity market outside of the US. So they are really a very significant component of global equities, far outstripping the returns on the S&P. And a lot of that has been driven by earnings. Now there is, I'm sure you've been discussing and hearing about valuations in the market, which we're going to touch on, but the Magnificent Seven in aggregate delivered far superior earnings growth, which has delivered much of that outperformance in recent years. In contrast, just for information, loss-making tech, those were, your Pelotons and so on, those companies that were really hyped in COVID when people thought the world was going to change forever. They were actually outstripping returns of the Magnificent Seven. That didn't last. So I think we can conclude that we can debate speculation, but speculation is not permeated back to loss-making tech. These companies are real serious cash flow generators in terms of the Mag 7. But multiples are high, as I've said. US market is trading on around 20 times forward earnings, the next 12 months earnings, as compared to developed markets outside the US, trading around 15 times, so around a third premium you're paying, but for that superior growth commanding a higher multiple. And bringing up the rear, as has been the case for a decade or more, emerging markets continuing to trade at a significant discount to developed markets more broadly and the US specifically. But one point I would make, just in terms of US equity market valuations, is one needs to consider the composition of what you're buying. When people talk about the UK equity market being cheap and the US equity market being expensive, you're not comparing apples and apples. The US market is very tech heavy, very heavy in fast growing companies. Conversely, the UK has got many great stocks, many interesting names, but it's a much slower growth profile in terms of the corporate sector in general. So what we can do is we can adjust the multiple of the market to take account for sectoral differences, so that when we make comparisons, things become somewhat more of a level playing field. And you can see when you do that, when you sector adjust PEs, the multiple in the US comes down to 17 times. Not cheap. Longer term, one might be looking at in the very long run around 15 times. So trading at a premium, but not as high as that headline number might suggest. So one needs to take account of the growth embedded in terms of the market. And in addition, on the right-hand side here, you can see that Magnificent Seven group of stocks, their expected PE. They're trading on around 26 times, and that includes very high multiples in terms of Nvidia, Amazon. On average, they're trading at 26 times. That is pretty much in line with the average of the last decade, actually. The setback that we have seen has taken multiples among that leading cohort of US shares back to long-run averages. And actually, we think selectively there's some quite attractive opportunities in that space emerging. So, in conclusion, and conscious of time, tariffs are front and center from a macro standpoint. Clearly, we don't know exactly where they're going to land in terms of whether the 25% proposed for the auto sector, whether that will stick, whether it'll be extended, what reciprocal tariffs are going to look like. But net, tariffs will reduce the overall growth outlook. They will impact business capex expenditure, impact consumer confidence, raise inflation, and therefore, on balance, the more that we see in terms of headlines and imposition of tariffs, the more negative that will become for markets. There's a big change in the Eurozone. The Eurozone has begun to perform after a decade or more of underperformance. We're seeing much better performance for the Eurozone, driven in part by a better fiscal outlook, and that is a multi-year story. The UK, we obviously had the spring statement just this week, but limited headroom, severe fiscal dilemma. That might improve in 2026, but ongoing challenges look like they're going to persist there. For equities overall, I think hopefully I've given you a sense about what we've delivered, not just over the last year, but in the longer term. It is really important to take that longer term perspective to remain diversified. Shorter term, we think the backdrop does remain relatively attractive for equities, but clearly a lot priced in and a lot to come in terms of news flow from President Trump and elsewhere. With that, I'll pass back to the host, and thank you very much for your attention. Thank you.